Now this video shows you by example how to derive the well-known Gordon Growth Valuation formula for equity using risk-neutral pricing. So the example that we consider is based on a firm whose dividend shocks are all non-diversifiable for the representative investor and therefore systematic. Now this says that all these systematic dividend shocks earn in equilibrium a risk premium. Mathematically, we write that idea by these two equations. The first says the dividends are growing in expectation by G, and that we have GD, the volatility of the dividend stream, times the Brownian motion shocks to capture innovations to dividends. And the SDF M has the usual representation of minus RDT minus lambda dBm. So BM are the Gaussian shocks to the SDF. They represent the non-diversifiable shocks in the economy. And you see that the dividend shocks are hit exactly by these SDF shocks. That implies that all dividend shocks are systematic. Now, the risk-neutral pricing measure Q is defined such that the following pricing relation holds. The price in time zero needs to be the expectation as of time zero under the risk-neutral measure Q of the integrated future dividends discounted by the money market account dt, where the money market account cap RT is simply the exponential of the integrated risk-free rates. Since the risk-free rate is constant here, it's just e to the RT. We can swap expectation and integration, and therefore we see that the price in zero needs to be equal to the integral of expected future dividends discounted by the risk-free rate and expectation taken under the Q measure. Now we use the differential representation to determine the value of these Q expectations. Now in my notation here I give to the differential operator a little Q index. Not sure you like it or not, I just do it for myself to keep track that I am aiming towards getting the risk-neutral dynamic. So what I want is, I want the Q dynamic of D times R inverse. Doing so gives us the following expression. Notice the risk-free rate is deterministic from T to T plus dt. So it doesn't co-move with dividends. And hence, the last expression simplifies to the following. Now, notice the next relationship here, which ensures that although we do risk-neutral pricing, there is a risk premium adjustment involved. And here you see where it comes from. Now let's start with the dynamic of dividends under the empirical measure P, which says the dividend growth is G dt plus GD dBm. Now by Girzanov theorem, we can rewrite the P Brownian motion as a Q Brownian motion minus lambda dt. That's what we do here in the second equation. So we put the lambda dt into the drift part, and we see that G minus sigma d lambda dt plus sigma d times dBmq coincides with the dynamic of dividends under P. But now here it's represented under the Q risk-neutral pricing measure. But because we have used Girzanov theorem the correct way, both representations under P and under Q are correct and equivalent to each other. Just the last equation I denote as the change of the relative change of dividends under the Q measure. And that's my dq over d index. Now interpretation-wise, once again, what's important? Important is that the risk-neutral Q dynamic of dividend growth contains a risk premium adjustment in the drift. That's because in our example, dividend shocks are systematic. Therefore, they earn a premium. Now, the expected dividend growth rate under Q is lower than under P if the market price of dividend risk is positive and if dividend shocks co-move positively with systematic stochastic discount factor shocks. So note, if you now discount in addition by the risk-free rate, you do in fact discount by the risk-free rate plus the dividend risk premium. And that is the reason why the Q price coincides with the P price. So let's go back to some math steps. Now we need dr that coincides with little r times cap r dt. Now by Ito lemma, if you want the change of r inverse, that gives you minus r to the minus 2 dr. And now everything is done under Q pricing. So again, for me to tell myself I want the Q dynamic, I write that as dq r to the minus 1. And that is minus r to the minus 1 r dt. And if I want under Q the change of r to the minus 1 over r to the minus 1, it's simply minus r dt. Now, let's connect the results. If we want to have the change of d r to the minus 1 divided by d to the r minus 1, we get that following good-looking relationship, which says it equals minus r minus sigma d lambda plus g dt plus sigma d dBm under Q. So the Q again highlights that under the risk-neutral measure Q, the risk-free discounted dividend streams grow with the expected dividend growth rate G minus the full discount rate, meaning you are discounting by the risk-free rate and by the risk premium. So now we continue. If we want to solve for dt times rt inverse, we can now see that it just coincides with the next expression here. As we take the conditional expectation and we have the Gaussian shock and the Brownian motion under Q, the half sigma square term in the exponential cancels out, and we just end up with d0 times the exponential of minus r minus sigma d lambda plus g times t. So going back to the pricing relationship, we therefore know that the price divided by dividends needs to be the integral of that exponential expression here. Now let's define the exponent to be a constant c. So it coincides with g minus sigma d lambda minus r. We assume it's negative so that the integral is well defined. And then we can solve the integral and we end up with the Gordon growth formula, although we used risk-neutral pricing. But we derived that the price-dividend ratio of a firm that pays an infinite dividend stream that is growing in expectation at a constant rate is nothing else than 1 divided by the discount rate minus the expected growth rate, where the discount rate is the risk-free rate plus the risk premium adjustment. So if you combine that with the other video on deriving the Gordon growth valuation for equity with the stochastic discount factor, you basically note that we've shown by example that the following holds. The price of any asset can be calculated two ways. You either discount future dividends by the stochastic discount factor and take the expectation under the empirical probability measure P, Or you discount future dividends by the risk-free rate and you take the expectation under the risk-neutral measure.